Huh?
You are a Trump fan, is it?
But I was watching this news for like 2 days. Fascinated by the event.
It's like all the stars are aligned for the bull market to continue. Yeah. If you love something, let it go. If it's yours, it'll come back to you. Applies in relationships and in the stock market. So in fact, I told my daughters, for two of you, don't diversify.
22% annualized for 5 years. Triple Q also has this kind of returns. Why not just buy some simple ETF and be done with it?
Welcome back to another episode of the Backholder Pod. And in today's special episode, we have Adam Khoo back on again. So I think the previous round that we had Adam on was around 1.5 years ago, was near the end of 2022. And back then, we still remembered that we were talking about the bear market. And then Adam was telling us how you should reframe your perspective. And true enough, I think after that 1.5 years, we are in one of the most incredible runs again from this whole AI semiconductor-led rally. So I think just to kickstart the entire discussion, I think Bunti, as evident from his Zoom background, Bunti has a few questions for Adam. So maybe I'll get Bunti to get the ball rolling.
Yeah, thanks a lot. So I have a chance to ask Adam questions, must ask a good one, right? So the first question, right, will market go up second half of this year? The reason I ask that is because people are asking me, say, oh, you see, there's all these elections upcoming. So election usually is good for the stock market, right? Now I'm passing these questions to you since you are the guru here.
Okay, so I always start off by saying no one can predict the short-term direction of the market with absolute certainty because there are too many moving parts, right? However, of course, we can always say what's the probability? Is it higher probability to go up or to go down? So, of course, the probability is that the market will gain in the second half for a few reasons, okay? So, number one is the technical probability, which is look at the charts. So, the charts are clearly on an uptrend, right? So, higher highs, higher lows. When a price on an uptrend, the probability is that prices tend to move higher. So, that's the first thing. Then, number two, if you look at, again, historical patterns, election years are bullish. Generally, election years are very bullish, regardless of who wins. Yeah. And normally in the election year, what happens is second half of July, there should be a dip. Yeah, August a rally. Then September, October, a bigger dip or correction. So maybe it could be 5 or 10% down in September, October. And then November to December, hallelujah. And the first half of the year, we were up more than 10%, which is quite rare. If you go back to 1950 to now, I think there have been about, if I'm not wrong, 12 or 14 years where the first half was very bullish. And in 83% of the time, the second half was bullish as well, with an average gain for the whole year of about 20+%. So based on probability, we should end the year up over 20%. Again, that's probability. We know that anything can happen. If suddenly the aliens land on Earth and, assassinate someone, head of state, or Russia launches a nuclear weapon, then of course everything is off the table, right? But based on probability, that's it. Then of course we have got the macro part where the US economy is like, again, in a Goldilocks scenario, where it's still growing, economy is still growing, jobs are growing, but not overheating. And we've got inflation coming down. We've got the Fed already hinting very strongly they will cut in September. So everything is like all the stars are aligned for the bull market to continue. Yeah.
Actually, Adam, I think got one common questions that we kind of get, right? Is that some people look at this whole rally from the SPY, which is the S&P, and then they say that it's up like 16, 17, 18% in the first 6-7 months of this year. Yeah. And a lot of people are kind of putting away their money. They're putting off investing because they think that they might be the sucker that buys at all-time high. And then they have missed this entire rally for the whole of 2024 because they are always waiting for the correction. So I just wanted to know if, let's say you are put in that specific position as well, how would you, not necessarily advise, but what would you do if you have missed?
If I'm someone who has not bought anything yet.
Yeah, since let's say late 2023 or the start of 2024, I didn't buy anything.
Okay, so the first thing I'll do is I'll ask my wife to give me one tight slap on the face. That's the first thing I'll do. Okay, then what will I do? Okay. So again, you have a choice. You either buy the ETF or you buy individual stocks. So although, like I said, I'm bullish for the rest of the year, but will I buy the S&P ETF now? No. Because as you know, my investment and trading decisions have nothing to do with where I think the market is going to go. So whether I think the market is going to go up or go down the next 6 months or 1 year doesn't influence my investing or trading decisions. That's what I always tell my students. The investing and trading decisions are based on my rules. All right. And one of my rules is always buy after a wave down, after a retracement to a level of support. And I always identify at least 4 support levels to slowly average in my position. So right now, if I want to buy the S&P ETF, it's an all-time high. Would I buy? Of course, I won't buy. Right? I will wait for a retracement to one of the support levels. I think in my last YouTube video, I did identify those 4 levels based on the historical moving averages. And then I'll wait for it to retrace. So again, it could retrace in late July, in September, in October, then I would buy in. But as always, you never want to all in one time, right? You want to average in. So out of $100, I put in $25 first, and then if the retracement gets deeper, then I slowly build a position.
Actually, what's the intention of like waiting for this like down, then only to enter? Is it really purely from psychology point of view, or is it really like that this kind of approach will really make the result better? Because sometimes after retrace, you buy already, it still come down. So what should we do, right?
Yeah, then you average down again. So I mean, there are many styles, right? So one style is you don't care about the charts, you don't care what the market is, you just buy. Then another second style is dollar cost averaging, which means you just put in the same amount every month or every 3 months or every 6 months, right? Then the third style is you use some technical analysis where you attempt to, because we know prices move in wave pattern, right? We know after wave up, you got wave down, wave up, wave down. This pattern always repeats because of emotions, okay? So since after a wave up, there's a wave down, and there's another wave up again, makes sense to buy after the wave down. But you never know how deep the wave down will be, right? Sometimes it can be a 5% wave down, 8%, you never know how deep. So that's why you buy in tranches, right? So once you get the first 5%, you buy a bit. Another 10%, you buy a bit. And then you get the next wave up. Now, in the long run, 20 years from now, does it really matter which method we use? No. Whether you all in now or you dollar cost average or you try to use technicals, in the long run, there's not much difference. There's really not much difference. Okay. But in the shorter term, there could be a bit of difference. In the next 1, 2, 3 years, if you had bought at slightly lower price, then of course you're going to have slightly better gains. Okay. So I haven't finished the answering the whole question, right? So that is if you buy the S&P ETF. Now, if you're looking at individual stocks, are there things you can buy right now? Yes. Because remember that although the S&P is an all-time high, not all the stocks are all-time high. Some stocks are all-time low. So there are those stocks you could buy. But of course, buy the high-quality ones. There are stocks that are down because of fundamental problems. Their earnings drop and all those. Now, those I would avoid. Okay? But I'll buy those where there's nothing wrong with the earnings. Earnings are growing, companies doing well, but the price drop for some stupid reason that is more sentiment-based. Okay, so I'll give you an example, right? Good example would be the healthcare stocks. United Health and Elevance Health, I've been adding. I added, I think about 2-3 weeks ago. My students have all been buying as well. Why? Why did United Health drop a few weeks ago? Nothing wrong with the company. Company earnings are very good because they got hit by cyber attack, right? And the stock dropped 10-15%. So those are great opportunities because those are short-term issues that will be resolved. It's not a permanent problem that they're facing. And even within the Magnificent Seven, Meta, yesterday, if I'm not wrong, it retraced to a support. So like Meta, one could add yesterday for Meta, right? Because Meta is undervalued, it retraced to the first support level, could add Meta, right? Amazon is also undervalued, and Amazon has been retracing, although not yet to a strong support. It's just above the support. So yeah, you wait a while. If Amazon comes down a bit more, then that could be a buy as well.
So Adam, it seems like you keep track of all your holdings like every day, right? Like for me, I just open up the app and say, oh, it's green, it's red, that's it. But for you, you know how much percentage, how it has gone up, gone down. How much time you allocate to monitoring your positions every day?
I would say, okay, if you don't count my options trading, right? Purely if it's investing, 10 minutes. At the most, I give you 15 minutes. Okay. And I guess one of the reasons why I have the discipline to do it is because I have to do it because I've got so many subscribers who are watching me. Now we have got thousands of people who subscribe to my UIP where they get my live buy and sell notifications. So because of that, I'm forced to watch it very carefully and be accountable to all these people. So in a way, it's good, right? So the first thing I do is when the market opens. Now, when I look at a market, really depends on when I'm free. Like right now, I'm in the process of moving house. So for example, 2 days ago, I was so busy moving things with my wife that I could only look at the market at 2 a.m. Then I could look at the market, all right? But on certain days, if I've got not moving my house that day, then when the market opens, then maybe 9:30, 10 o'clock, I look at it. So the timing depends on when I'm free. And once I look at the market, I'll spend, like I said, 10, 15 minutes. And the first thing I do is I look at my portfolio stocks. The stocks in my portfolio, I go through them. I've got about 46 right now, 46 stocks in my portfolio. So I go through them, and I'm going through all their charts one by one. 5 minutes, very fast, right? And what I'm looking for is, where are they right now? Have they retraced to a support level? If it has, and I don't have a full position, then I'll add more shares that day, all right? Or I will sell put options on it, which is what I do almost every day. I'll sell put options on those stocks to earn some premium, right? Then I'll look at my watch list. Then the watch list are the stocks that I have not bought yet, but they have passed my criteria of a good business. Then I look at the watch list, right? And that takes me another 5-7 minutes. Yeah, so same thing. If the watch list stocks is at undervalued, it's at a good position, then I'll buy. Okay, or I may sell a put. Yeah. And then the third thing I do, maybe another 5 minutes, okay, is then I will run through some stocks that come out of my scanner. So these stocks that come out of my scanner may not be very good companies, but they happen to have high volatility. Then those stocks, I would just do short-term trading. Not investing, but short-term trading. I call it my one-night stand list. Yeah. So all in all, 15 minutes.
Hey Adam, you talk about buying during dips and pullback, right? Because I watch a lot of your videos. You love to say like the stock will always breathe in, breathe out.
Yeah.
But recently I've been watching the Nvidia rise, right? Then my wife sort of got interested and I say, hey, this one can buy or not? Then I say, wait for it to pull back. And then it just keep going up. I think there was one time it went down like 6-7% max. And then the next day, the market just roared back. And then it just keep going higher and higher. Yeah. So if let's say we are unable to catch it, we don't stay up until 2 a.m., we're not the sort, would you recommend that we just get in like maybe 20% of how much we want to get in? Just get our foot in first. I don't know. I think someone actually espoused this, say that, hey, buy a little bit in first. Then if it comes down more to the support, then you load in more. Do you think that is a good approach to do?
I think the first question is, if it's an investment, is it undervalued? That's the question you got to ask.
Yeah.
If it's undervalued, yeah. But if it's not undervalued, it's way overvalued, then why do you want to buy? So a lot of people always get fixated, oh, I must buy Nvidia now because it's so hot. Or a few years ago, I must buy Apple now, it's so hot, right? Hey, there are 6,000 stocks or 7,000 stocks. Why must you fixate on that one? Why? You don't have to, right? I remember years ago, I read about, one of Warren Buffett's greatest advantages is not his intelligence. Although he is intelligent, but there are many people who are just as smart as him. But one of his advantages is his patience and the discipline, right? And one of the stories that fascinated me was that for many, many years, he wanted to buy American Express. He said, I love the company. I use the product every day, but it's so expensive. And he kept watching it. He watched it until one day when the stock got into trouble, he was sued by someone, I can't remember, right? And the stock dropped something like about 40-50%. And then he started buying. And then eventually he made billions on American Express. Until today, he's still holding the stock. The question is, how long do you know he waited? How long did he wait and watch the stock every day before he bought it? 7 years. That's his patience. Imagine watching a stock every day for 7 years, just waiting for the day you get a price. So that's what Buffett calls like you're a baseball player waiting for that perfect pitch. You don't just swing every day at every ball that comes your way. That is the patience the man has.
But there will be a situation where you just wait for like 6 months and the stock's just like 3x already.
He wait 7 years. Yeah, no, that's fine. And let it be. You know,
wait for other,
because there'll be other stuff you can buy. That's why all these are emotions that, oh, you know, if I bought it, if I bought it, I would have 3x. And you cannot think that way. If it's yours, it's yours. It's not yours, it's not yours. If you love something, let it go. If it's yours, it'll come back to you. Applies in relationships and in the stock market.
Yeah, because it's a bit harder because every day I see the Nvidia going up, and then my wife say, "Hey, how come you never buy? But how come Bunti has?
Yeah.
Watch Adam's video.
So it's all these emotions, right? The FOMO and that messes us up.
Yeah.
So, I mean, that's why Warren Buffett doesn't live in New York, right? He lives in Omaha with all the sheep, and he doesn't get affected by all these things. Look at all the greatest investors. Many of them didn't buy Nvidia, and they are still doing very well, right?
Yeah.
Yeah. So why must you buy Nvidia?
Because Bunti has it.
Hey, Adam also has it, right?
Hey, Adam, I just have a question. Sorry, because just now you talk about Meta, right?
Yeah.
You remember the recent episode where they had a very bad quarter, and then Zuck was saying that they will spend billions and billions, like 100 billion or something like that. Then the investors were all freaked out. Then there was a lot of Meta investors that actually kind of panicked because they see it as a structural thing. So they are going to keep burning money. And I remember even the All-in podcast, they were talking about it. They say that, hey, this doesn't seem to be booked very well because they are spending a lot of their cash flow. So I think that is when a lot of even fundamental investors, they bailed out of the stock. So my question is, if you are a long-term investor, right? Let's say you've been investing since like the very early days.
Yeah.
And then you saw that their focus is so much on this metaverse, which is not taking off and is burning a hole in their pocket.
Yeah.
Very big hole. Would you actually consider selling it, even if it was like a long-term investment? And on what criteria would you see before you will deem it suitable to buy back in?
Okay. So I was holding Meta all the way. I've been holding Meta for many, many years, and I held it all the way through the 70% drop.
Wow.
And I bought more. Yeah. So, okay. So to answer your question, now to me, I was not concerned at all. Okay. Because when I was doing the discounted free cash flow valuation, when I did my intrinsic value calculation, I assigned zero value to the metaverse. I assumed that it will not work already. And even when I assumed that it was zero and I put in all the cost involved, my intrinsic value was still, I can't remember the exact number, but it was still way above the current share price. So that means the market, how do I say, it already priced in all the bad news, and the market assumed the worst already. Yeah. So my assumption was, even if the metaverse didn't work out, even if it went to zero, the shares were worth a lot more than what I could buy for it. Two, see, to me, I ask myself this question. Okay, the only time I'll sell a stock is if I feel that the business, their economic mode, their competitive advantage has been lost or is deteriorating. Then I'll get out. Okay. So there are two reasons why I was confident in Meta. The first reason is because I myself, I'm a customer of Meta. You know, as you know, Piranha Profits, we spend millions a year advertising on Facebook, on Google, and all that. Okay. So I asked myself a very simple question. I asked my marketing team a question. Are we still going to advertise on Meta next year? Yes. Are we going to advertise more? Yes. Right. And is there any alternative that I could I could advertise besides Meta? No. Right. So that gave me confidence, because I realized that if I, a customer, will continue to advertise on Meta more and more in the next 5-10 years, their mode is still there because there's no alternative to Meta. Who's the alternative? TikTok? Maybe, but like my target audience, they don't really watch TikTok. So I have to advertise on Facebook. So that's the first thing that gave me confidence, right? Mm-hmm. The second thing was the problem something that Zuck could change if he wanted to? That means if Zuck wanted to, could he say, okay, fine, let's stop spending on metaverse. Let's just focus on the core business. Could he have done it? Yes. That means it's within his control. So as long as the thing to be fixed is within the control of the CEO, he could change. He has about to change it, and the mode, the customers are still spending. What's the problem?
He made the own problem.
Yeah, he right? He did himself what? So anytime he could stop, and which he did, in fact, right? So the moment he cut his capex on the metaverse, the stock went up.
Right.
The biggest problem is our own paper hand. So I paper handed during that period, and Chicken so smart got in during that period.
That's why, right? It is very important that the big positions you have should be on stocks where you are the customer yourself. Because if you are the customer yourself, then you really understand the business. And the good thing about myself and the fact that we spend on ads on Facebook and all that, right, is we get invited down to Facebook HQ in Singapore. So we know the people working in Facebook, and we talk to them every day. And we're like, hey brother, how's the sales? So they're like, sales very good, right? And we can see for ourselves that their business is still doing very well.
For just like you mentioned about this everyday look at the stock market for 50 minutes, right? So I just now went to calculate, it's about 7 hours each month. So let's say if I'm not Adam Khoo, I have nowhere near his level of expertise, right? So why not just buy something like QQQ or SCHG and get the same returns for way less effort? Because like you can show us your portfolio returns I think it's about like 22% annualized for 5 years. QQQ also has this kind of returns. So like why not just buy some simple ETF and be done with it?
Can. But no pride. Yeah. No, but yeah. True, if you look at the last 5 years, because what was driving the market the last 5 years was tech. Right? So obviously you buy QQQ, then you get the same or even better, But if you go back many, many years before that, it's not always tech that leads. It's not always tech that leads, right? So, like for example, 2022. 2022, it was a tech that had the biggest drawdown. And if you were all in on tech, then you would have a very big drawdown. But in 2022, what did well? It was the non-tech, right? Energy did well. You had consumer staples that did well. McDonald's, Yum Brands, all those did very well in 2022. Okay, so I keep telling my students and my subscribers that my objective is not profit maximization. It is not. It is capital preservation. It's capital preservation. So if my goal was profit maximization, then I wouldn't be so diversified. I would like all in onto Nvidia, or all in onto Bitcoin, or all in to the tech stocks. But I'm not, right? My portfolio has got Pepsi, I've got United Health. I'm diversified, so that I know that my portfolio will continue to do well under all kind of economic situations, whether high interest rate, low interest rate, economic growth, or recession. My portfolio will do well, right? So again, it depends. Now, for my 2 daughters, where I'm mentoring them with their portfolio is very different from my portfolio. So in fact, I told my daughters, for 2 of you, don't diversify. Don't diversify. Because my 2 daughters are only 18, 20 years old. Their runway is longer than mine. Their runway will be, 40 years, right? So I told them, to my 2 daughters, just go tech. Just go all in tech. And because their account is relatively small, it's not in the millions, it's small. So if those big drawdown come, it doesn't really matter that much.
Actually, if I can chime in here, So when Kelvin was talking about that, because they were asking, right? And then I think it's also part of the Beat the Market event. So the title of Beat the Market. So they wanted to know Adam's performance. And then I pulled out the record of the last five years plus. It was roughly around 180+%. So I think when Kelvin asked me that question, my first response was that true. I think it's true that a lot of people just gotten to know about the QQQ over the last 2 years. Maybe in 2019, if you bought the triple Q, yeah, you also did that 180% in 5 years. But the truth of the matter is, not a lot of people knew too much about the triple Q back then. And if we we took a hindsight bias thing, when we look at 2019, and then I went to look back in time on when the triple Q did 180%, they took roughly since 2011 or 2012. So that took around 8 years for them to do 180%. And then the last 5 years, they did another 180. So a lot of these are quite hindsight bias and saying that, oh, you could have just bought the triple Q. And then who knows, maybe the S&P will outbeat the Q again in the next 5 years or so. So that's why that was my thought process back then. And if you did buy the triple Q, then congrats to you, especially during the drawdown of 2022. Hope that you didn't paper hands too and try to time for a better correction as well. So there were a lot more nuance in the discussion there. So yeah, that's just my perspective. So I think we had the honor of getting Adam on. Just a quick shout out. So for those of you who haven't been following, so Adam has been outplaying the S&P for the last 5 years. I think he beat them by around 1.5 to 1.8x. And we are going to have a mid-year event upcoming on the 27th of July. So if you guys are interested, the link to the event itself is below. You will hear more from Adam. I think he will talk a lot more about his current positions, how he look at the market, how he's intending to play this entire AI wave, etc. Yes, Beat the Market 2024.
I mean, it's the same thing as people asking me, Adam, why you want to waste time? Just buy Bitcoin. If you bought Bitcoin 5-10 years ago, you would have gotten more returns than you doing all your work, right? But again, that's hindsight bias, right? But how do you know where Bitcoin will be in 5, 10, 15, 20 years? I don't know. I don't have a clue. Only Cathy Wood knows. Only Tom Lee knows. I don't know because I don't know how to value it. But I know where Microsoft will be. I know where Amazon will be because people will keep buying on Amazon. People keep using Microsoft. That I know.
Actually, on this topic of returns, right? I think you also did share in a lot of your YouTube videos talking about supercharging your returns with options trading, right? And you do a lot of options trading yourself. And personally, because I got to know you better, you basically guys I guess the pet phrase that you have is always just sell put lah. If it's a good company, just sell put lah.
In fact, when I was selling chicken, right? When I was renovating my house, I was thinking in terms of puts. So my wife said, "Oh, Adam, we have to buy this lift. It's 100,000." I think, "Oh, okay, I have to sell 100,000 worth of put." Okay, Adam, we gotta buy this curtain. It's gonna cost 40,000. I think. Okay, so many contracts of put. So I was thinking how many put options I must sell to pay for my house.
Yeah. So on that note, is CSP or in this case, is selling puts really just like in a way free money? Or
to me, the way I do it is really free money to me. Okay, I wouldn't dare to say to anyone else. To me, because I know what I'm doing. I know what I'm doing because I've been doing it for so many years, and I did it during the 2020 bear market crash. I did it during 2022 bear market crash, and even during those two bear markets, at the end of the year, I still made over $250,000. I think more than $250,000. Yeah, during the bear markets on selling puts.
But then here's the thing about selling puts, right? So there's an expiration date. What if the stock touches your strike, then it bounces back up? Won't you miss the buying opportunity? Okay,
so for those of you who don't know, put option, the way to think of it is when you sell a put option, you're selling insurance. Every year you have to buy, you pay a lot for your car insurance, for your house fire insurance, for your medical insurance, right? And who collects all your insurance premiums? The insurance company. So wouldn't you love to be the insurance company collecting premiums from so many people? Now, once in a while, there'll be a car accident. You have to pay out the claim. Once in a while, someone go to the hospital, you have to pay out a claim, right? But at the end of the day, the premiums you collect are more than enough to cover the claims, plus you make a profit. Correct? So that's the insurance company business. And today, I see myself as the insurance company in the stock market. So every day, literally almost every day in the stock market, I'm selling insurance on stocks. Okay, so that's selling put options. So first of all, I have to know what's the intrinsic value. Okay, so my intrinsic value of Elevance Health is about $600. Okay, and now it's at 550. Okay, so it's undervalued. Now, about a week ago, it dropped to about 530. Now, when it dropped at 530, could I buy the stock? Yeah, I could, right? But since I already have quite a bit of shares, I thought I play hard to get. So I sold a put option at $510. So what does that mean? When I sell a put option, I'm selling insurance and I collect a premium. So when I collect a premium, I'm now obligated to buy Elevance Health at 510. Right? If the price stays below 510 by the expiration date. Okay. So if Elevance Health by the expiration date stays above 510, the insurance I sold expires and I just collect the free money. I get free money, right? But by the expiration date, if it stays below 510, then I'm obligated to buy the shares, which I don't mind because it's a very good company, it's undervalued. So to me, it's a win-win situation. I can't lose, okay? Now, if at the last minute I choose not to buy the shares, at the last minute I say, I don't want the baby, okay? Still can go for abortion, okay, right? So what I do is I buy the put back and then I sell another put. We call that rolling down the put, okay? So in a nutshell, that's what I do. If I really want to buy the shares, I'll just buy it. I'll buy it directly. But if I'm playing hard to get, it's like, I am mine. It's like, if I'm playing hard to get, that means I already have the shares, but I don't mind having more. But if I don't have it, it's okay. Then I'll sell the put.
Do you need a lot of cash at the sideline just to make yourself not become emotional? Because sometimes, I mean, for us, maybe, especially to those who have smaller portfolio, sometimes it's like you sell one put, it's already, there's a stake there, right? So it dropped, let's say 10%, it's already in the money, and then we say we don't mind buy it, but it's actually much bigger proportion as compared to our portfolio, then we become emotional because of that. Down the road, we might change the strategy because it's like, oh, it's too much for my portfolio. If I want to cut loss, also difficult. So do you like have students encounter this kind of problem, and how do you guide them through all this?
So the rule I always tell people is that you should only sell a put if you really have the money to own all the shares. If you don't have the money to own the shares, don't sell the put. Because if you do that, you will get, again, emotionally affected, right? And for people with a small account, they should not sell a put by itself. We call it sell naked, right? They should sell the put and buy another put below that first put. So we call that a bull put spread or a credit spread. If you sell cash secured puts, to me, it's like almost 100% sure make money because I follow certain rules. Number one, I only do it on very, 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 very safe companies. Okay, so I wouldn't dare to sell a put on Tesla or PayPal, or even now, although I do own a small stake in Estee Lauder, I wouldn't dare to sell it on Estee Lauder because they're having some operational issues right now. Okay, so I will only dare to sell it on very safe companies that the earnings are growing, the very strong balance sheets. So your Meta, your Microsoft, your United Health, those things. So I'm very selective on which stocks to sell puts on. That's number one. Number two, I only sell the put if the price is really quite undervalued. That means it's quite undervalued already. And when I sell the put at a strike price, it's even more undervalued. So in the event that I have to buy the shares, in my mind, I must feel that it is very safe already because it's a very good company. It's really very cheap. One thing that kills people is greed. Okay, like if you see, I sell options. Okay, I'm only using roughly about 5% of my portfolio to sell options. Only 5%. I can actually go a lot higher, but because I'm very conservative, I just only use 5% of my portfolio to sell options. And to me, the premium I collect, of course, I could get a lot more, but to me, it's enough. I'm happy with it, right? So I know that in the worst case scenario, if we go through another financial crisis, we go through another .com crash where the whole market dropped 50, 70%, I know I'm still okay because I keep my positions relatively small to my portfolio. when people sell puts, why they get into trouble are three reasons, which is I mentioned. They do the opposite. Number one, they sell puts on risky companies. Number two, they sell put when the price is overpriced. Or number three, they oversell. And if the market suddenly has a 30, 40, 50% drop, they can't hold the share, they can't hold the put, they get margin call, they get wiped out.
Last week I was watching your video, then you mentioned that this 2024 is a good year, because it's an election and it's the second year of the bull market and so on, right? But if we assume that this whole Trump thing, he got elected historically, like 2018 was a good, during his presidency, it was a good period because like he did all those stuff, right? But he also introduced those China tariffs. Back then it was like 10 to 15% China tariff. And back then the inflation was low. But going forward, when inflation is high, and Trump is planning to introduce this 60% China tariff. So do you think that like 2025 onwards would be a bad period for the stock market?
Okay, generally the first year of a president's term, which is 2025, tends to be more bearish. It tends to be more bearish. Whoever gets elected. Whoever gets elected. But if you ask me between Biden and Trump, they both have their own problems. For example, Biden's problem is he wants to raise the corporate tax rate quite significantly to, I think, over 30 or 35%. So that is going to be not very good for a lot of the companies that we own. Because mentioned the tax rate go up so much, their profits drop a lot, that will affect the intrinsic value a lot. And Biden also likes China tariffs. It's not that he doesn't like. He also, in fact, whatever tariffs Trump imposed, he continued with those tariffs. All right. On the other hand, Trump will continue with the corporate tax cuts and may even try to reduce it further. So that will be very bullish for the companies. But on the other hand, he may impose even more tariffs on China. Okay. So I think at the end of the day, every president, there'll be pros and cons and good and bad. And net is impossible to know what's going to happen. But if you look back at history, whoever is in power, at the end of the day, it doesn't really make a difference. If you look at how the stock market performs under Republicans and Democrats, it's actually not that different. So it's not something that I really worry about or think about.
Okay, any more questions for the US market? If not, we'll move on to
the Indian market. Okay, no, don't ask me. I know nothing about that. I only eat prata, that's all.
Okay, move on.
Okay, maybe not a bit too far from home, right? Then maybe let's go back down to the Singapore market. I think in Singapore specifically, a lot of people love dividend investing. They like REITs, they like the banks. And actually on our podcast, we have made a 3-part series where we basically expose the pros and cons on both sides about specifically REIT investing. And I just wanted to get your thoughts because I do know that you have quite a sizable REIT and bank exposure in the Singapore market as well. Because a lot of people are saying that the low rates of the last 2 decades are kind of a thing of the past. And maybe moving forward, the new so-called new normal might be 2-3%.
Yeah.
And we might know that actually a high rate environment might not be very ideal for REIT specifically. And a lot of people actually do swear by this idea of dividend investing. And they say that without dividends, I cannot buy the stock. So I just wanted to know from your perspective, do you think the heydays are over? And do you think, is there a problem with this asset class moving forward?
Okay, first of all, let's talk about banks. Okay. So I'm a very big fan of the 3 Singapore banks. Very, very big fan. In fact, the 3 Singapore banks make up almost half of my dividend portfolio. Almost half. And it provides me a very good passive income for a few reasons. Number one, the Singapore banks have relatively attractive dividend yield. Now it's come down a bit because the bank price have gone up quite a bit. But even then, it's still above 5%. If you look at the dividend growth rate, like DBS, their 10-year dividend growth rate is over 12%. That's very, very attractive. With a yield of now 5%, forward yield 5.5%, right? And if you look back at history, even during the financial crisis, even during the dot-com crash, they kept paying dividends. And their dividends only dropped marginally. The only time they cut their dividends significantly was 2020. And it was not because they couldn't pay dividends. It's because MAS stopped them from paying dividends. But later, after COVID, they made up for it by paying back the shareholders. So if you look back at history, their dividend payout is very consistent and very predictable. So I'm a big fan of the banks, right? Number one. Number two, let's talk about REITs, right? So REITs really got whacked in the last 2 years. Now, it is not because of the high interest rates that whack the REITs so much as the rapid rise of the interest rates. So if you look back at the last 20, 30 years history, there were actually certain periods of time that when the Fed raised rates and the 10-year treasury yield went up, REITs also did very well. There were many times like that. So it's not the high interest rates that's bad for REITs. It's the fact that the interest rates went up too fast, which was in 2022 because of the super high inflation. So you see, as a REIT, right, when rates go up, how are they affected? They have to pay more interest on their debt, right? But if the REITs own good quality property, they can raise their rents to offset the higher interest costs, which is what happens during past rate hike cycles. So in past rate hike cycles, the Fed raised rates, their interest costs increase, but they raise rents, no problem. They continue to do well. Okay. But in 2022, what happened was that the rates went up too fast that they couldn't raise rents fast enough to offset. So that is what affected them. Okay. Then the second thing is, of course, when rates go up too fast, the cap rate of the property goes up and that reduces the valuation of the REIT. But again, that's temporary because once the rates come down, cap rates go down, their valuation should revalue up. A good example is Cromwell REIT, which owns a lot of the European property. So Cromwell REIT, their portfolio valuation dropped in the last 2 years because cap rates went up. But the last quarter, their portfolio valuation started going up already, right? So to me, that's a temporary issue. One of the things that I really learned from the last 2 years was you should only stick to the high quality REITs. So like, for example, in Singapore, there are 42 REITs. I would say only 10 or less are high quality. Okay, and of course, there are many metrics we look at. One of the most important metrics is the gearing ratio. So ideally, you want the gearing ratio to be 40% or less. If the portfolio value drops too much and the gearing ratio goes above 45, 48%, then the banks could recall the loans from the REITs and they could really get into big trouble. Yeah. So stick to REITs that have got low gearing ratios, that have got consistently increasing dividends per share, consistently increasing net asset value per share. They've got a history of doing yield accretive acquisitions and NAV accretive acquisitions. You should do very, very well.
So you are saying for of us that didn't focus too much on dividend and we still come up with videos that dividend investing is stupid. We are the one that's stupid.
You all say it's stupid, really.
We put it in the thumbnail actually, not really in the content. In content, we make up, we put on the pro and con.
So it really depends on where are you at your stage of life, right? So of course, like for my two daughters, am I going to mentor them to do dividend investing at this time? Of course not, right? Because at their age, they should just focus on growing the portfolio. But only when they reach their 40s, their 50s, their 60s, then they start to shift into dividend type of investing. REITs, banks, and recently I've been buying private credit assets as well. Private debt assets.
Adam, so for your daughters, right? Like, when did you get them started in their financial education? Was it like when they were just like 3 years old, you just like, hey, you need to...
But probably when they were in primary school, when they were 10, 11, 12, I started to influence them. So whenever we went out, for example, we went to McDonald's, I would say, how much do we spend on our meal? We spend about $15 on our meal. And I asked them to count the number of people at McDonald's. I say, multiply that. How much did McDonald's earn in revenue within the hour we are here? And I asked them to roughly estimate how much you think McDonald's makes in revenue in a week, in a month, in a year. Right? And I get them excited about that. And then I tell them, okay, but they have to pay the staff salary, they have to pay the rent, they have to pay the cost of the burger. What do you think is their net profit? Right? So from primary school, I started getting them to think that every time they walk into a shop, whether is it a boutique or a restaurant, that business is making money. I get them to think that way from very, very young, right? And then I said to them, I said, do you know that you can own McDonald's? Right? When they walked into Starbucks when they were younger, I said, do you know you could own Starbucks? How? Then I showed them the phone. See, you can buy the stock. Then you're one of the owners of this business. So I started to influence them since they were in primary school. And then the moment they turned 18, which was the legal age to open a brokerage account, straight away I taught them to open an account. Yeah. And I was very proud of them because I started with 5,000. I give them each 5,000. I said, that's it. That's your seed money. The rest you put in yourself. And during all the school holidays, they will go and find their own part-time job. I didn't push them to do it. They did it themselves. And I was very proud when, my elder daughter came up to me and she says, oh, I just got my salary. I want to put it into Interactive Brokers. I said, wow, okay. I didn't tell her to do that. And then from there, I said, okay, I match you 1 for 1. Every $1 you put in, I put in $1. Then I realized it was a bad idea because 3 weeks ago,
She put 3 million.
No, my elder daughter said, I'm putting 8,000 in this month. And my second daughter, I also want to pay 8,000. I was like, oh shit. So then now I put a cap. I say maximum 1,000 a month top up. As in my maximum match is 1,000. Anything beyond that, I don't match. If not, I'm gonna go fast.
Later, she says she found even the better business idea, which is borrow money from a friend and get 100% from there.
Oh yeah. Yeah.
Adam,
So,
the last video, right, when you came on, right, we actually also asked you about when you were younger and all that, right? Then you were saying that your father, he was like quite stingy with you. Like he doesn't actually give you a lot of money, even though you guys were quite okay, well-to-do. Is that like also been passed down from you to your daughters? Like as in you don't want to give them too much. You say, I give you a little bit, the rest you have to get it yourself. So that is
more or less. Of course, my wife spoils them a bit more, but more or less, yeah. So, and the great thing is that they don't ask for a lot of things. Like during their birthday, I asked my elder, "What do you want for your birthday?" She said, "I don't need anything. I'm pretty happy." Right? So they're not greedy. That's a good thing. And in fact, the first time she got her first salary during the part-time job, and I brought her out for lunch. As a father, you always pay, right? But then Dad, let me pay now. So I'm pretty proud of that.
wow.
Yeah. So I think they've got a good value. I think they've got the right values.
How do you manage to train them up that way? Like, because obviously you are a bit more well-to-do, right? Then when we see people who are more well-to-do, their kids are a bit there's a certain kind of attitude to them. But how do you avoid?
Well, I think the kids learn more from what they see than from what you say. So they can see that I'm relatively frugal. Like up to now, I still haven't bought myself a car. I take Grab around. They can see that. So they won't ask me for a car because Dad takes the Grab. Why don't you go and take the Grab yourself, right? But they take the bus most of the time, right? Same thing. We don't really eat at fancy restaurants that often. Of course, once in a while we do. But fancy is also like Tim Ho Wan. That's fancy to us. We don't go to those like Michelin star kind of place. But more often than not, we're at hawker centers, we're at coffee shops. So they watch how me and my wife, we live a relatively simple lifestyle. And yeah. So I guess, yeah, they learn from what they see in you, right?
But just like 2 portfolios that you show publicly, also people can see that it's like high 7-digit or 8 digits kind of net worth, right?
Yeah.
And how to tell them that actually you don't have to spend so much money. It's easier, let's say, for the average family because we just say that the family income is such and such, so we should live a moderate lifestyle. But for you can afford it, right? How do you convince them that actually don't need?
Don't need to convince them because I think from young they have learned that we are very happy, and the happiness doesn't come from a branded bag, or the happiness doesn't come from a Michelin star meal, right? The happiness comes from the family time we spend together. I think that's one of the things that they've learned, that buying things does not make you more happy. What makes you more happy is the time you spend with your family and your friends, the relationships that you have, and that's free.
I think last question now. So what's the best financial advice you have gave your daughters?
The best financial advice, I don't think it's one. I think it's a lot along the way, and it's the timeless advice that we have learned ourselves from books at a time, like make sure that you spend less than you earn. The same thing, right? Spend less than you earn, and then always have savings to put into the market, and to only buy high quality companies.
Okay, I think with that's quite an extended discussion with Adam. And of course, for those of you who want him back on, we need to get bigger, guys. So y'all need to help subscribe and help smash the like button as well. Then maybe you can get Adam on again, maybe check in 2026. I think with that, I think we'll see you guys in the next video. Goodbye.